enabling the digital economy.
So welcome everyone, thank you for turning up. This is my 14th Cyber, so I feel quite old about this. But as you can imagine, correspondent banking is at the heart of Cybers for the last 40 years by now. So that's a big anniversary we've just celebrated. And therefore we felt, given the immense technology change over the last 5 to 10 years, and the permutations and statements in the market, that correspondent banking will be easily replaced by some fancy ledger that everyone will immediately adopt, and that will do magic to all of our data and all of our AML and KYC and risk concerns. We felt it was very good timing to look at the correspondent banking landscape and to primarily look at cross-border payments, which of course in a global economy becoming more and more important. So we started our research to think about, is it technology that will change this? Is it going to change overnight? What are the other ingredients we should look at? And frankly, first of all, what is the actual problem we see in the market? What's the market failure? What are the things that are not working well? And how can we think about new business models, governance models, and additional services that can actually make this business a safer business, a more efficient business, and a business that reconnects people over the whole globe? Because in the last few years, we've obviously seen a lot of de-risking, a lot of disconnection of specific markets because of AML, KYC, and CTF concerns. And therefore, how do we actually get back to a more healthy industry? We actually went to SWIFT last year, and we had a questionnaire out. We had a session last year, as Peter mentioned, and we validated a number of the concerns we saw in the market with some empirical research, which was our starting position. And then we said, okay, for those interested, let's get involved as an industry group and focus on how we can think about a different set of design criteria and scenarios to address the issues in the model. And also to come up with some policy recommendations, some standards recommendations that can complement this. So obviously we started with the general definition of correspondent banking, which I hope I don't need to explain to anyone in the room. Interestingly, of course, a lot of businesses and a lot of individuals in the market are maybe not always familiar about the complexity of the actual business, the level of standards required, the level of data checks required, and that can sometimes, when you're on the sales side, be a bit of a surprise when in the back end people have real issues with certain participants or their clients. So we looked at the key risks and costs and issues in the market. We identified, obviously, credit counterparty risk, regulatory risk as one of the biggest risks. People had lost trust between each other. Obviously, a lot of data issues came out. And as we've seen many governments fining banks for particular AML and CTF concerns, it started to become quite an expensive business if you don't do it right. The classical issues such as transaction fees, network fees obviously add to the mix of this, but also liquidity cost and capital cost, depending on how far your jurisdictions have implemented Basel, are another concern for quite a number of important markets. And then I guess a key issue is always real-time visibility of everything to do with the transaction, but also everything to do with your balance sheet. If you don't predisposition, if the credit lines are not assured, etc., you can have a lot of cost and a lot of surprises. And in fact, as we see more visibility coming into the correspondent banking chain, we can actually start addressing some of those current problems we see. In particular, obviously, the de-risking piece, the increase of concentration. So, Barbara.
So, just to get down to a little bit of the details of what we have done, we started the research trying to come up with a few very well-defined research questions. So we wanted to try and understand what are the key problems, the key pain points in the correspondent banking industry, and what are the issues with the way the market currently operates. And then from that, we wanted to understand what are the key requirements if we were to come up with new scenarios and new ideas, and how we wanted the cross-border payments industry to work, what requirements this new model should satisfy, and then what would be a viable design future for cross-border payments. And all this keeping an eye on the standards, regulatory and governance-related principles that you cannot ignore in the cross-border payment space. So how did we set out to do this? We started with designing an online questionnaire. The online questionnaire was brief on purpose, tried to understand what were the key pain points for the industry in the cross-border payment space. And we had an idea to start with, and what we wanted to do here is to actually get some validation that our ideas of what were the key pain points actually corresponded to what the industry felt the pain points really were. The questionnaire was distributed via SWIFT. We presented some preliminary results, as Peter said, last year in Toronto. The response rate was lower than we anticipated, but still we had a good geographical spread of respondents by region, by location of the bank headquarters, and also a good spread between users and providers of correspondent banking services. So what were the key results of our questionnaire? We ranked them in a line of the strength of the problem. We calculated the strength of the problem looking at the ratio of respondents who agreed with the statement to those who disagreed. And what we found is that by and large, the key pain point was a lack of visibility of the transaction-related costs. For example, who has paid which fees to whom, for validation, for AML, for counterparty and liquidity risk. So the visibility and the transparency through the life cycle of the payment were the key pain points, even ahead of costs for messages or the fees charged by the bank. Those were perceived as problem, but not the key drivers. So we took this set of initial results and we put them to industry participants who were involved in correspondent banking, and we organized a number of industry focus groups. During the focus groups, we sought participant views first on the survey results to see whether they agreed with the ranking of pain points, but also we tried to go further than that, and we tried to discuss what can be done to try and overcome these pain points. These are well known in the industry, but how can we move a step further? So how can we design a model for payments that overcomes some of these pain points? And what are the areas that we can actually add value? So having done that, we have managed with the industry focus group to come up with a set of key requirements. And this was the main outcome from the focus group, a set of key requirements for a future cross-border payment model. And these requirements go from settlement to liquidity efficiency to 24/7 availability, ubiquity, transparency, predictability, and interoperability. So these are the kind of wish list that you would want for a future model of correspondent banking. And based on this, we came up with our kind of proposal.
Exactly. And I think if you just reflect on the wish list for a second, I mean, these are not a ranking in terms of 1, 2, 3, 4, 5 in terms of importance, but we particularly wanted to look at aspects of financial stability, given the fact that the whole industry is built on credit lines, and that in times of crisis, credit lines that are always non-committed can create a real problem and bottleneck. And obviously we've seen the financial crisis in that context as well as the fact that transparency of where is the payment, who's paying out on time, who's not paying out, is something that can actually help a lot in the settlement question, because we don't have true settlement finality if we're talking about interbank line, nostro-vostro payment alignments per se. In some cases, of course, the payment ends up in a local RTGS, but that would be the very last mile. So we looked at those aspects from a stability perspective. We had a number of central banks, including the Financial Stability Board, that worked with us in that group. So for them, stability obviously is very important. But we also looked at how can we create something that is akin to a global currency or a global payment system, even though we know we don't have one. And we also all agree that Bitcoin and other cryptocurrencies are not going to be the global payment currency. We have sovereigns, we have all the things that are happening, and we also see several central banks experimenting with new technology about how they can maybe cross-interact with each other, but again, people would still maintain their distinct currencies, and that was sort of a little bit the context in which we reflected on these types of requirements. Interoperability standards is a classical one if we look at initiatives such as the Single Euro Payments Area, which I kind of worked with for many years. That was a big interoperability play, but that tends to work well in a region that is a bit more aligned also politically. It's something that is very hard to achieve cross-border. So we came up with a set of 7 design scenarios. 7 was probably magically the outcome, so we must have done something right. And we really looked at different models that either exist or that are starting to be conceptualized, or that are maybe models that are complete future visions, but could become more relevant as things evolve, both at a technology, governance, and geopolitical level. And I would say the geopolitical part is actually quite an important driver of making things either happen or preventing things from happening. So the first thing we obviously looked at is SWIFT GPI. And I think this is really the example of where the SWIFT network as a community, as an existing governance structure, really comes into play in terms of realizing the importance of the network effect. We worked with SWIFT for many, many decades, but now, given all the external drivers, competition, technology, etc., GPI really is addressing the fact that transparency has to play a key role, and it is using new technologies such as cloud and obviously existing APIs in terms of allowing for a lot more data transparency and tracking, and we're probably hearing a lot of GPI already Monday, Tuesday, and already until the end of the week on that particular topic. As a second scenario, we looked at a narrow clearing bank. So how about connectivity platforms that connect players, payment service providers, and banks to clearing systems, and could that be something that could be expanded globally? And we start to see some clearing bank scenarios locally, but not yet globally. We looked at the alternative concept of connecting automated clearing houses directly. And again, SEPA is a good example where it sort of worked with EACHA in Europe, but it was a long struggle of more than 10 years. And it's something that you would think now with more instant payment system or real-time payment system, ACHs around the world, and things like request to pay, et cetera, developing, that could be maybe something that could become more viable. Again, ACHs today are not necessarily for high-value payment. Obviously, you don't have that settlement finality in central bank money. So again, we looked at it also with a financial stability head-on. Then we looked at the integration of regional RTGS systems. We've got examples in the Gulf, for example, where they created a sort of Uber RTGS that manages the flows between the different countries. Very interesting concept. Politically, governance-wise, a long shot, takes a long time to develop, but of course would give you that settlement certainty in central bank money. And interestingly, in Australia, you see almost a merger or hybrid between high-value, low-value clearing with actual finality in central bank money at the back of it, which is also an indicator that you will probably see a lot more blurring of the boundaries between high-value and low-value. Then the fifth scenario was a very sort of visionary scenario of thinking, how about we have some global settlement utility that sort of takes out the counterparty risk in settlement, at least for high-value transactions, a little bit like what we've developed many years ago with CLS on the FX side. Again, that is a very complicated model to achieve in practice because you would be working with lots of different regulatory regimes, governance, changes to work process flows within the banks, but you would achieve obviously settlement finality in central bank money. And you could maybe argue if you can do maybe some cross-border connections between central banks using new technology, that could even be mimicking this utility model. We looked at synchronization and interconnectivity of RTGS systems using new technologies such as distributed ledgers. One concept is sort of more the settlement coin within the central banks between the actual commercial bank, and the other idea of synchronization is something where some central banks are actively exploring new technologies and thinking about how they could sort of work cross-border. That has also sort of stumbled across some political and guarantee-related questions. And then the last one is really that next level of GPI, which SWIFT and our community is working on right now in terms of adding a lot more services, including more value added in the sanctions, KYC, AML, and rapid response space. And of course, a lot more transparency now with the new release, with people implementing the UETR, and then everything you can build up from there going forward. So then we started ranking those because we had established our requirements. So we started ranking them across the requirements and found that when we want to address the combination of financial stability question marks and the transparency lack that people see in the industry today, we actually feel that GPI already starts to address those problems. Obviously, transparency is a key one that's being addressed right now. But my point is that once you have more transparency in the chain, real time, like a DHL tracker of your package, you also know which truck is not delivering the package on time, where things get stuck, and you can more actively react and stop certain flows to certain institutions that may have either a technical issue, a cyber attack, or just internal or external fraud. And that's something that we really didn't see in the past, and people were exchanging things, didn't know where the payment gets stuck, and then sometimes certain lines would build up and certain risks would build up, and of course if an institution were then to go down within that transaction time span, you would lose all your money, a bit like the Lehman case. And that's why we feel GPI from a pure data and connectivity layer perspective, bringing the network alive, is something that if everyone implements it properly, or even if they don't, because you will start to see where the bottlenecks are, there will be a peer-to-peer pressure to actually implement, and then you can start building on that. So even though GPI itself is not the biggest innovation, it is actually looking at the network from a different perspective and also starting to use more agile technologies such as cloud and API to get it done. GPI next generation is obviously then that next level, and I think we haven't even started to think about how many other things we can build on top. We have a lot of good ideas, and we've been exploring with Swift and the team already where these ideas are going. But I think once we start seeing literally the majority of institutions following and implementing the basics, we can start to see the benefits, and we will see the client demand for having it done. And that'll be something that obviously the banks will have to respond to. So one way or another, you will have to invest if you're a bank, and you'll have to do the right thing. And I think that's a very, very good outcome. Obviously, the regional RTGS connectivity is something that does exist, well, starts to exist in the Gulf. There are some initiatives in Africa as well. This was ranked as third because it provides that settlement finality in central bank money, but we're very conscious about the political and governance-related difficulty to make that happen in a global context, because obviously not every nation wants to work with every nation, even though we have the sort of utility idea of a CLS for payments. Even that is very complicated to execute, and of course it only covers a certain set of countries. The clearing bank and ACH connectivity were ranked as 4th and 5th. Clearing bank seems to be a more agile approach to get it done than actually connecting the ACHs. But again, it may not address the finality risks on settlement that we see in the high-value payment space. Market utility, as I said, was so far removed from execution opportunity in the next 5 to 10 years, which was a little bit our horizon, that we said we put this a little bit lower down the chain, because maybe technology allows different ways of connecting the hubs that we may not need a utility. And of course, a big utility like this always has the risk of too big to fail associated to it as well. And of course, that's something that you will then have to manage. So you never get the risk out, you just keep on moving it. And the final one on the leveraging new technology between RTGS is something that is in the early stages of more research that central banks are undertaking. But you would actually have to have central bank commitments on payment guarantees, payment performance guarantees, if you do synchronization. If you want to take out the credit risk at the commercial layer, let's say on the MT202 cover side, and you get central bank earmarking, if something doesn't work on the commercial bank layer, the central bank would need to step in. And we don't see that willingness of central banks to do so at the moment, because central banks are actually not payment providers. And they don't really want to be, and they also like their two-tier system, as it were, in terms of their own risk management. So now we would like to ask you, hopefully having informed you slightly sufficiently about the criteria, and please read the paper if you haven't done so, whether you agree with the ranking or you don't, or you have slightly different focus points. So we've got 4 questions with regard to the ranking. Do you agree with the ranking, disagree with it, prefer focus on alternative technology solutions, which we've taken on board in a more limited context, or prefer the status quo? At least when I see the last one with the majority, I know who's in the audience. Okay, please, off you go. Slido. Okay, that's lovely. Thank you very much. And I think we want to build up from there. So this was almost phase one of a research that, as things evolve, will continue and will factor in more and more initiatives we see both at governmental level as well as industry level. But that is a very helpful endorsement of our findings, I would say. So that's very positive. And of course, technology always plays a role. But the key learning from this research really is not only do we understand better what the problems are, but we also know that technology itself cannot fix the problem. It has to have a business case, it has to have a governance, and it has to have that network. And that's why we feel an area which has already built network over time with the governance is more likely to be able to build things on top of that network and still allowing that competition in the customer to bank level. So if we go, I guess, to the final slide. We have one with a conclusion, right?
Yes, we do.
Yeah, that's our conclusion. So please, anyone in the room who is a bank or payment provider and you haven't done GPI yet or you're just looking at it, go and do it. That's the first very practical recommendation. Continue to work with the community to build it out further. Share the needs you see in your markets, because this may actually be able to shape different types of solutions that we're going to build on top of that network. Obviously, in terms of our policy recommendations, which I'm only addressing here in the conclusion, this is very important because we need government support to continue streamlining rules around AML, KYC, counter-terrorist financing. This has been a challenge over the last few decades, and governments are starting to realize the importance of streamlining because they see how new technology solutions that are completely borderless circumvent all of their rules. I mean, Bitcoin as an example of that. So it's much better to think more proactively on how to harmonize global rules and therefore help the industry to be both compliant and efficient at the same time. Obviously, adoption of ISO 20 or 22, I don't need to say it here. This has been a topic for the last 20 plus years probably, is something that is going to become more key in terms of a larger data set, and obviously that's going to feed into the SWIFT message structure itself. We also clearly recommend using the legal entity identifier as a standardized global identifier to identify entities. We're even proposing that one could think about having a personal, natural person type of standardized global identifier in order to cover that consumer customer segment, because this will become also more important as everything becomes more ubiquitous in real time. And look at new technologies in terms of whether they can really help fix the problem, and in how far also some of the new technologies are still immature, but researching and development to occur for them to become more mature. So for example, distributed ledger technology is, in my view, foundational. It will become a lot more important, but it is about the right focus. What is missing in some of the applications we see today? Not only scale, but how you share data, obviously data privacy. A number of issues are being addressed, but don't underestimate the challenge of moving to a completely new tech stack with a whole industry of thousands of banks globally. So that's why incremental step by step will become more relevant in order to actually address the problem than a complete extreme cut into something very, very new. And it's not technology alone, it's also SLAs, it's rule books. We will see that with next generation GPI to have a focus, for example, on the high value interbank space, with stricter rule books on applying credit and informing the other institution that credit has been applied. And again, that will take out stability risk without requiring central bank settlement in central bank money, which I think is quite a neat outcome. Happy 40th anniversary.